All right, so we're kind of jumping into the second half of the property, plant, and equipment material. Basically, we're stopping. The last chapter stopped at the acquisition point. Now we're saying, okay, what do we do with these things after we've acquired them? And so, the big idea of this, of course, is cost allocation. So over time, you allocate the cost of these assets and expense them over time. So again, the difference here is capitalization versus expensing. So if we capitalize a cost, we put it on the balance sheet as an asset, and then we expense it over time. And this cost allocation is that process of allocating a cost over time. And so imagine I have an asset where the original cost is 82,000 and the residual value is 22,000. And so essentially of the value of that piece of equipment, we consume $60,000 of it. And so in this illustration, we're just sort of saying, okay, in some sort of process over a 5-year period, we're going to consume or use up $60,000 of that asset's value. And so that's sort of this idea of cost allocation, although of course we're not specifying exactly how we would do it. We're just saying that over time, this would be the process that we'd go through. So we'd originally have an asset worth 62,000, we're going to consume, or sorry, 82,000, we're going to consume $60,000 of that value through some process, and we'll be left with $22,000 at the end of 5 years. And so when we think about sort of what that looks like, or how we think of the that consuming of the asset, if it's a fixed asset such as plant and equipment, that process is called depreciation. For natural resources, it's called depletion, and for intangible assets, that's called amortization. And so all of these, again, we're allocating the cost. We're not necessarily directly measuring the value, but we're saying, okay, we have this cost or this value initially, and we're making assumptions about consuming that. And so again, that process is just the idea of consuming that over a period of time, whether it's depreciation, depletion, or amortization. It's just a matter of what we're applying it to. And so when we measure it, there are really three factors that we have to focus on. Number one is the service life or the useful life. And so how much do we expend, how much do we estimate that we're going to use it? And so sometimes it's going to be measured over time. Sometimes that might be measured over an amount of activity, but somehow we have to measure the service life of the asset. And then the second thing is we have to measure the allocation base. Sometimes this is called the depreciable base. And so that's basically how much of that cost or we assume is going to be consumed. And then in the example we just had, that would be that $60,000. So that's the allocation base or the depreciable base for that asset. And then finally, the method. So there are different methods that we can use. Again, we'll kind of get into those details, but several different patterns that we could adopt to say, okay, I'm going to consume this much in year one, this much in year two, this much in year three, and so on and so forth. So looking about the service life or the useful life, again, it's meant to measure or capture the amount of use. A lot of times it is measured in time, but it doesn't have to be. And so what is the difference between a physical life and a service life? So the physical life is that upward bound. In other words, it's essentially how long it can possibly last. But a service life, a lot of times it's going to be less than that because it's only the amount of intended use. And so something may last for a longer term in terms of time or usage than what I plan to use it myself. And so most of the time, the service life is going to be shorter than the physical life, but it doesn't necessarily have to be. So the allocation base, again, how much of the asset are we going to consume? The two key ideas here are the capitalized cost and then the residual value or the salvage value. Again, another term for that. And essentially, this is how much we are going to consume of that asset. So the three types of bases. First of all, again, the one we've talked a lot about is depreciable base. That deals with plant equipment. There's also the depletion base, which is for natural resources, and the amortization base, which is for intangible assets. And so we use depreciable base a lot just because most of the assets fall in the plant and equipment category. What are some challenges to estimating the residual value? One is it's unclear. In other words, how much of that value of that cost is going to be left at the end of the service life. You can use prior experience. You can use sort of heuristics. Most often, though, companies are just going to end up using zero just to kind of keep things simple. And one thing I highlighted in the lecture in person that I want to highlight here is at the end of the day, whether I depreciate an asset completely or whether I depreciate it partially, the end result as far as like the total impact on my income over a long enough period of time is the same. In other words, if I pay $60,000 for a piece of equipment and I use it and eventually sell it, let's say for $20,000, in total I consumed $40,000, right? So I think I said 60 minus 20, I consumed $40,000. Now, if I think about that $40,000, there's really two ways I could arrive at it. I mean, we could go extreme, and let's say that we depreciated zero. So we 60,000 and we never touch that asset. When I go to sell it and I only get $20,000, I'd have a $40,000 loss, which means the negative impact on my income over the life of that asset was negative $40,000. Let's say that instead I depreciated it exactly $40,000. So the book value at the time that I would have sold it would have also been $20,000. So there'd be no gain or loss at that point in time. So all of that expense would be depreciation expense. So we're consuming all of it through depreciation. Let's go the other extreme. Let's say that I 100% depreciated it. And so I'd have $60,000 of depreciation expense, but then when I sold it, I would have had a $20,000 gain. And so in total, my net loss or my net negative impact on my income would have been net $40,000. So regardless of how much I depreciate, it's just changing sort of when I recognize an expense and how I categorize it, but it doesn't change the underlying economics, just to kind of be clear. All right, so then the third thing is let's talk about the allocation method. So the method should reflect, basically acceptable patterns, right? So GAAP provides general guidance and gives you some ways that you can do it, but basically there's a pattern that you have to adopt as far as how we're going to allocate that cost over time. And so there are two general approaches. The ones that you're probably used to is time-based. So basically, straight line evenly over time. Double declining balance is kind of over time, but a little bit accelerated. But there is this other one called activity-based methods. We won't cover that one in this lecture. We'll cover it in the next lecture. But rather than using time, you're going to use some sort of usage base. And so be either input or output based, but it's not time based anymore. Okay, so depreciation is a very common example, one you've probably seen before. So we're dealing with a piece of equipment here. We acquired it for 425,000, which is going to capture the total capitalized cost. And they made some assumptions. One is they estimate the residual value is $75,000. The service life of the equipment is 4 years, and the estimated production is 250,000 units. And so the actual production, which is not known, I'm not going to use it actually for this lecture. We're going to use it for the next lecture, is 275,000 units over a 4-year period. I'm just going to kind of talk about how that might impact it when we get to that next lecture. But for now, we're going to focus on our time-based methods. The first one is one I'm guessing you're all familiar with, which is straight line depreciation. Very easy. It's by far the most common method. And so again, it's an equal distribution of the allocation over the service life of the asset measured in, years. If you did depreciation every month, of course, you'd measure it in months. For this class, we're going to kind of keep it simple and do things annually. So in our example, what would the annual depreciation be? Well, this is the equation that we would use. So the capitalized cost minus the residual value divided by the service life. And in our example, the capitalized cost is 425. The residual value is 75, which means we have a depreciable base of 350,000. Divide that over 4 years, and we get $87,500 per year. Again, hopefully pretty straightforward calculation. And by the way, at any point, if there comes to a question and you want to think about it first, just pause the video and then pick it up once I start, once I start answering it. So much like the book, we're going to kind of, there's just some terms that we're going to use that we need to be familiar with. And hopefully, we get the idea that when we're thinking about depreciation, we need to understand what's the annual depreciation expense, what's the accumulated depreciation for the asset, and of course, then given that accumulated depreciation, we have to understand what the book value is. And so thinking about each term, depreciation expense, again, that's the amount that's allocated in the current year or current period, depending on how you're looking at it. We're looking at annual periods, which would be a year. And that depreciation expense is what's going to be on the income statement. The accumulated depreciation, again, I think you're familiar with this, but it's that contra asset. And basically, as depreciation expense is recorded, that amount gets accumulated into this permanent balance sheet account. It's a contra asset. It's reported as a negative number on the balance sheet. It has a credit balance. And so that it just continues to grow. So that accumulated depreciation amount just grows and grows and grows and grows over time. And then finally, the book value is sometimes called the carrying value, but it's that capitalized cost minus the accumulated depreciation. So as the accumulated depreciation grows, the book value of the asset shrinks. So looking at our straight line example, the depreciable base again is the capitalized cost minus the residual value. So that's $350,000. The rate, again, with straight line, it's even over every single year. So the rate is 1/4 or 25%, which is 87,500 per year. That's what we just calculated. And so after the first year, the accumulated depreciation is 87,500. And again, the book value is the capitalized cost, which is 450,000 minus the accumulated depreciation, which in this case is 87,500, which means our end of year book value is 337,500. And then in the second year, the pattern continues again, straight line depreciation, it's the same amounts. The accumulated depreciation, of course, now is doubled because we've got 2 years. And the book value, of course, is reduced by that amount. And so the book value is now, 450,000 minus 175, sorry, 425,000 minus 175, which gets us 250. And that just continues on. So eventually, notice we end up at a book value which is equal to the residual value, and that must be the case every single time. So no matter the method, we will go from that original cost of 425 down to 75. So if you kind of took one line above this, the beginning book value is 425, and then we're going to end up at 75. But of course, we just kind of march down there evenly, following straight line depreciation. But it will always be the case that the residual value is the ending book value for the asset, which means that the accumulated depreciation must equal the depreciable base, which is 425 minus 75. Hopefully the journal entry isn't too challenging. It's the same every year. You record the depreciation expense of 87,500, and of course that's driven by the increase in accumulated depreciation of 87,500. Again, hopefully fairly straightforward. At the end of each year, what do we report? So you're going to report the depreciation expense on the income statement, but of course, it's only the expense for the current year. And you're going to report the book value of the asset on the balance sheet. Sometimes it'll be combined into one account, or it can be separated into two accounts. If it's combined into one account, it would be like, equipment net of accumulated depreciation, and it would give the net value, and it would give the amount of that accumulated depreciation. But as you saw in intermediate one, we typically just separate them into two separate items. Declining balance. This is another time-based one, but it's an accelerated method. And so with an accelerated method, you're going to have higher depreciation early in the life and then lesser amounts later in the life. And the reason why it must be lesser amounts later in the life of the asset is because the total depreciation or the accumulated depreciation is set to that $350,000. So we can't have any amount over that. So whether we accelerate or not, if we have more early on, it must be the case that we have less later on in the life of the asset, because the total, regardless of the method, has to be the same. The most common one is called double declining balance, and what double refers to is you're doubling the straight line rate. And so in our example for a 4-year asset, the straight line rate is 25% per year. So the double declining balance rate would be double that, which is 50%. So we would depreciate the asset 50% per year. Unlike a straight line method, this is important, is we do not use the depreciable base. Instead, we apply the rate to the beginning of the year book value. Very important that you understand that's what we're applying this to, the beginning of the year book value. So double declining balance is a little bit different in that it's accelerated, and we apply the rate to the book value instead of the depreciable base. And so in our example, the depreciation rate we just calculated is 50%. We apply it in the first year to the beginning book value, which is the capitalized cost. 50% of that is 212, which means since it's the first year, that's also our accumulated depreciation. And the end of year book value is 212,500. Again, it's 425 minus the 212,500, which gets us 212,500. Now, in the second year, our 212,500, that's our revised book value. Now, our capitalized cost is the same, but the way we're going to calculate depreciation expense is a little bit different because we're applying it to the revised book value. So the end of year book value from the prior year is the beginning of the year book value for the second year. So that same rate of 50% applied to our beginning book value means our depreciation expense is going to be 106. Our accumulated depreciation, now, of course, we're summing them, right? So it's the 212,500 plus the 106,250 for a total of 318,750. The end of year book value is our capitalized cost, which is 425, minus 318,750, which means the end of year book value is 106,250. We take that and bring it down. So now our beginning of the year book value is 106,250. If we use the same depreciation rate of 50%, I put it in red. You're going to see why in a second. If I did that, you'd notice that the depreciation expense is 53,125. The accumulated depreciation would have been 371,875, and then our end of year book value would be 53,125. The issue is that the residual value is 75,000. If we've blindly followed this process, then our end of year book value would be too little. In other words, we would have depreciated it more than we should have. Remember, at the end of the life, no matter the method, the book value has to equal the residual value, and the accumulated depreciation cannot be more than the depreciable base. Remember, the depreciable base was 350,000. And so instead, what we have to do is essentially plug a number. Say, well, we need this balance since the normal depreciation is too much. We plug in the amount. In other words, we stop depreciating the asset. And so to go from 318,750 to 350, the amount of expense that we need is $31,250. So we plug that in and we get the end of year book value of 75,000. And then the last year, of course, we fully depreciated it. And so we don't have anything left to depreciate in that fourth year. We just leave everything as is. The last method here is one that is not commonly used, but it is allowable under GAAP. So I'm going to kind of quickly cover it. I'm not going to go into a lot of depth. But essentially, it's another form of accelerated time-based depreciation. And sort of the approach is, a little bit different. So you calculate a base. And the base is based on the number of years in the asset's useful life. So in our case, we had 4 years of service life. And so we take 4 plus 3 plus 2 plus 1 for a total of 10. If it had been 5 years, then this would be 15. If it were 6 years, it'd be 21, and so on and so forth. But we sum of those years. So 4 plus 3 plus 2 plus 1. And then you depreciate it basically in like reverse order. So in the first year, it's 4/10, in the second year, 3/10, and then 2/10, and then 1/10. If it were 5 years, it'd be 5/15, then 4/15, then 3/15, and so on. So essentially, if I add this up, I'm going to end up with 100%. Because 4 plus 3 plus 2 plus 1 is going to get you exactly 10. So over the course of the 4 years, you will depreciate the asset 100% of whatever that base is, but it's just in the reverse order. And so the way that mechanically works is, again, because it's that 100%, we're depreciating 100% of the depreciable base. And so our sort of the driver of it is the depreciable base of 350,000, and that's the base every single year. And then the rate in the first year is 4/10, and then of course it drops down 3/10, 2/10, 1/10. And so we multiply it across. So 350 times 4/10 is 140. And so therefore our cumulative depreciation is 140. Our book value again is the capitalized cost of 425 minus the accumulated depreciation of 140. And so when we add that all up, we get 285 for the end of year book value. And then we calculate the next year and we sum everything up until, of course, we end up at that residual value. Again, because of the method, we're going to end up exactly at the residual value, just like we did with the straight line method. And so, again, no matter the method, our accumulated depreciation at the end of the service life will equal the depreciable base. And then the book value, of course, is the residual value. So I'm going to stop there. I went a little longer than I wanted to, but sort of awkward. And we'll pick up the next one with the next video.